In business today, three things to know. First, Obamacare up in the air. The insurance companies react to President Obama's plan to uncancel millions of policies. But can they get it done? Then, downgraded. Moody's lowers the ratings on 4 U.S. banks over concerns that the government won't be there to bail them out again if they get in trouble. And in the corner office, a man who sees the opportunity in bringing the yogurt craze to minority communities. It's Friday, everyone, and Arise Exchange starts now. Hello, everyone. I'm Andrew Schmertz. Troubles in Washington not translating to trouble on Wall Street as the S&P 500 has notched its longest weekly win streak in 9 months. The momentum train pushed the Dow and S&P 500 to new records. Many analysts say investors are reluctant to sell because of year-end tax consequences. And of course, many mutual funds want to throw on the window dressing before 2013 runs out. Today, it was energy and materials leading the S&P, while consumer-related sectors lost ground. We're going to talk about the impact of Obamacare. Maybe it's a contrarian indicator, and the downgrade of some U.S. banks in this half hour. But first, here are the final numbers for the week. The Dow Jones Industrial Average did finish the day up 86, closing in on that 16,000 mark to 15,962. S&P 500 up 7.5 to 1798. And the NASDAQ closing up 13, also closing in on a 4,000 number to 3985. Three stocks to watch today. Apple down 317 to 525.08. Joseph A. Bank up 41 cents to $50.72. Joseph A. Bank dropping its takeover request of Men's Warehouse. And T-Mobile up 47 cents to 26.05. Commodities overseas. Gold here in New York, up $1.80 to $12.88, and oil down 2 cents to 93.74. The Wall Street rally goes on as investors show no fears over concerns about Obamacare or anything else for that matter. Peter Cardillo, once again, here from Rockwell Global Capital. Good Friday to you, Peter.
Good to be back.
Let's start with the Obamacare situation. This is not rattling the markets. In fact, there was an article earlier today that I was reading that says maybe the more trouble that the Obamacare is having, maybe better for Wall Street. Why?
Absolutely, because, I think one of the problems that we have in terms of creating new jobs is this fair factor of the Obamacare. Small companies are just reluctant to hire new workers. And what we're seeing here is a new norm within the labor market now, and that is part-time workers. So if the Obamacare should stall and blow up, I think we could probably see government actually move out of the way in terms of creating new jobs, and we would see the jobless rate come down rather quickly.
So for Wall Street, a little bit of continued dysfunction in Washington on this issue is probably an okay thing.
Yeah, I would kind of think so. Okay. Markets are telling us that.
Are we seeing pure momentum right now in the markets, or is this still a move on some fundamentals?
No, there's certainly, we're looking at momentum, and there's no question about it. But look, what happened here in the past 2 days is we had the Yellen effect, Yellen effect, Mrs. Yellen certainly did not disappoint Wall Street. And it certainly looks as though she's going to be confirmed. There's no battle. There was really, at her hearings, the opposition party certainly didn't go out of their way to beat the drums out of her. So she will be most likely the next chair lady of the Federal Reserve. And so, her dovish position remains intact, and as you saw the results yesterday and today.
And she gave the Republicans a little bit to hang their hat on yesterday, didn't she, when she said this won't go on forever?
Absolutely. And, even though I'm going to be wrong about the tapering in December, next week, we have the FOMC minutes, and it's going to be quite interesting to see how they assess economic activity, at least how they forecast it from the previous month, and I think that who knows we might just still get that surprise. And I say simply because, we do have before the mid-month December FMOC meeting, we have a slew of economic data coming out. And of course, the December-November employment indicator. If that should show jobs growth in excess of 250,000, I think the Feds might just say, hey, we need to taper here. That doesn't mean they're going to end the program, a small amount.
You were calling for 1,800 on the S&P 500. Do you think we might now just blow past that number by the end of the year?
1,800 is a round number, just like 1,700 was and 1,600 was. And we will reach there. Obviously, nearly got there today. But I think the market is going to show little signs of stress trying to pierce that 1,800. So if we do pierce it, I do expect a little bit of a pullback.
A little technical stress?
Yeah, a little technical stress, So I think we're going to get a little bit of a battle here over the next few weeks as we try to get through this 1,800 level. That's not to say we're not going to get there. I think we will, obviously. And there's a good possibility we might get to 1,825, 1,835 by year end. But, that means that going into the new year, when we generally have the traditional January effect, we might have a reverse effect this time.
A little bit of a pullback. Okay.
Yes.
Peter Cardillo, thank you so much. Have a good weekend.
Thank you.
Okay. A day after President Obama announced a fix to the millions who have had their health insurance canceled, there are questions as to how that will actually work. Mr. Obama acknowledged that he fumbled the rollout of the Affordable Care Act with technology problems with the website and a more substantive problem of millions of Americans receiving cancellation notices because their current policies don't meet the standards set by the law. Here is the president.
Those who got cancellation notices do deserve and have received an apology from me, but they don't want just words. What they want is whether we can make sure that they are in a better place and that we meet that commitment.
The Wall Street Journal is reporting that insurance companies haven't received guidance on how to reverse the cancellations, and many are questioning if they can even pull it off. Further, they may need to get permission from state insurance regulators, and that's going to be tough. For example, the state of Washington has already said it would not comply with the president's edict, and even in the president's backyard, the Insurance Commission of Washington, D.C. says he believes that reversing the cancellations undercuts the laws. So where do we stand? Brian Smith is Senior Vice President from Verisk Health. Joins us from Salt Lake City in Utah. Brian, thank you and welcome back to the program.
Thanks so much.
So, Brian, is this really a big deal for the insurance companies? Help explain this to the layperson. They sent out these letters. Why can't they just send out new letters saying, we changed our mind?
Well, first of all, remember this only affects people who have individual policies. And individual policies, as you probably know, are all individually underwritten. So you've got a subset of people who are fundamentally pretty healthy folks. And this is what really caused such consternation is, wow, I had this tailored plan. If I didn't want maternity, I didn't have it. If I didn't want mental health, I didn't have it. But now you're saying that I'm canceled and I have to pay for a benefit level that I don't want. That was a problem. Now, the issue here is that Obama's proposal essentially delays for a year the provisions in the Affordable Care Act that required insurance companies to end policies such as these that didn't meet the law's minimum coverage standards. Well, think about this. Think about running a business where you, all of a sudden, you've spent a lot of time and energy. In fact, you haven't even filed in the states for insurance. In other words, all of these plans, they thought they were going to be going away, so they didn't file rates. They didn't do any actuarial work on them. So now, all of a sudden, here comes this curveball from Washington. We really didn't mean this. We're going to push this back a year, so all of these people who have individual plans will be able to keep them. Well, guess what?
They can't do it.
What is that going to do? They can't do it.
So, Brian,
the practical reality is this is probably the worst possible scenario. I don't think anyone could have imagined anything worse than this kind of changing in the middle of a deal.
So, Brian, what is the solution here, if there is one, for the insurance companies and their customers?
Well, the insurance companies have to do business with the federal government. Most of the major companies have Medicare Advantage programs. They're going to do what's politically expedient, frankly. And so I think they're going to come up with some ways of of making this work. They'll send out another letter that goes something like this: "Hey, just kidding about that cancellation. If you'd like to stay in the plan, you can." And to the degree that people move out of these plans, let's assume for a second they can do that. Let's assume for a second that the state will allow that, unlike Washington, right? The people that are going to retain those plans are going to be the youngest and healthiest people. Those people, of course, are going to stay out of.
That is, Brian, we have about 30 seconds, but that is one of the problems here is now there's concern that the system could not self-sustain itself because the young people will buy those plans, which doesn't pay enough into the exchanges.
Well, and it's not that they can buy those plans, it's that they can renew those plans, right? So they're not going to be available for anybody to enroll in, but they can keep them. Well, the people that are going to keep them are the ones that are the healthiest and have the lowest premium.
Right.
The fundamental issue, we talked about this last week, there's a bunch of risk corridors and risk adjustments, but at the end of the day, who's paying for that? The federal government's paying for that.
Okay.
So it's going to raise costs for everybody. It's just a debacle. I mean, it's an actuarial nightmare.
Okay, Brian, thank you so much for explaining it to us.
All right, we're good.
Okay, Brian Smith, have a good weekend. Coming up, in China, if you like the first, now you can have a second. And the good news behind the bank downgrade. You are watching Arise Exchange. And welcome back to Arise Exchange. Time now for other business headlines of the day. JP Morgan Chase expected now to announce a $4.5 billion settlement with investors seeking to recover losses from mortgage-backed securities sold to them before the financial crisis. The group, composed of 21 institutional investors, previously received an $8.5 billion settlement from Bank of America on similar claims. The deal must still be signed off on the several trustees overseeing the securities, including Bank of New York Mellon Corp, as well as needing court approval. This is separate from the $13.5 billion fine that JP Morgan is negotiating with the government. China loosens its decades-long one-child policy. It's one of several key reforms approved by Communist Party leaders during its historic and secretive four-day meeting earlier this week called the Third Plenum. The birth policy, first introduced in the 1970s to rein in China's surging population by limiting couples to one child, will now allow couples to have two children if one of them is already a child. The reform couldn't come soon enough, given the disturbing effects of the old policy. With an aging population and low birth weight, China's workforce is shrinking, causing the supply of cheap labor to dry up, as well as fewer children available to take care of aging parents. And most alarming, the growing imbalance between girls and boys. Seriously, if you're a guy, try getting a date in China right now. In 2010, there were 51 million more men than women in the country. The sex ratio among newborns is 120 boys for every 100 girls, for example. That's the highest in the world. At this rate, there won't be enough brides for as many as 1/5 of today's baby boys when they get to marrying age, posing a risk to social order. Warren Buffett's Berkshire Hathaway has taken a major stake in ExxonMobil. Berkshire bought a little over 40 million shares of the oil giant, valued at about $3.7 billion. As the sixth largest holder of shares, it could give Buffett the ability to influence policy and leadership decisions at Exxon. U.S. factories increased production for a third straight month in October as stronger output of primary metals and furniture offset declines in auto production. The Federal Reserve reported manufacturing output rose 0.3% last month. That's up from 0.1% in September. A former JP Morgan Chase executive is facing extradition to the United States. Javier Martin Arturo, who oversaw another ex-trader nicknamed the London Whale for his large bets on derivatives markets, was indicted by a U.S. grand jury back in September. He is accused of helping hide over $6 billion in trading losses while he worked for the bank in London. Although Martin Arturo's turned himself into police in his native Spain, he is challenging a U.S. request for extradition, which now rests in the hands of Spanish courts. Microsoft co-founder Bill Gates is asking Norway to pay up to help Africa. Speaking in Oslo, Gates said Norway should invest some of the $800 billion that it has saved up in oil revenues in the world's poorest countries in sub-Saharan Africa and Asia. Gates, who oversees the $37 billion Bill and Melinda Gates Foundation, added that Norway, by some measures, is one of the richest countries in the world and could afford to help out people in other places. Norway's surplus oil revenue is expected to top $1 trillion this decade. And it's game on as Sony and Microsoft launched their latest gaming consoles for the holiday season. Today, Sony unveiled its PlayStation 4 in North America. The next-generation computer entertainment system is priced at $399. And next Friday, Microsoft launches its Xbox One, which includes an updated Kinect motion sensor, a big reason why it will cost $499. As we mentioned at the top of the show, 4 of the biggest U.S. banks had their ratings cut by the ratings agency Moody's Investors Services. This after Moody's decided that the government would be less likely to help them repay creditors in a crisis. The 4 banks are Morgan Stanley, Goldman Sachs, JP Morgan Chase, and Bank of New York Mellon. They had their ratings lowered by 1 level. So what impact will the downgrade have on bondholders, investors, and consumers? Let's ask Westwood Capital Managing Partner Dan Alpert. Dan, welcome to Arise Exchange.
Good to be here.
Okay, so why don't you just first walk us through what happened today?
Well, Moody's decided to go along with pretty much what Standard & Poor's had done already, which was recognize the fact that the Dodd-Frank Act and all the regulations that have been promulgated therefrom actually put the banks at great exposure, put the bank holding companies, I should say, at great exposure to their creditors in the event of another crisis. In fact, what the law has done is it's made it impossible for the government to bail out bank holding companies, which, of course, that's until they pass another law during the next crisis.
And decide too big to fail again, right? Because of the financial crisis.
But based on existing law and regulation, in theory, the banks themselves will be wound down by the FDIC, and the bank holding companies' creditors will actually lose their credit.
And from a philosophical standpoint, shouldn't the creditors be the ones at risk as well as the equity holders?
Absolutely. I don't think there's any disagreement with that, unless you, of course, are a bank creditor.
Right, who wants to be bailed out. Does this say something, though, about the bank's strength, maybe that the banks are getting better and stronger and they won't need the government handout?
Well, it says a number of different things. It says that the notion of financing banks with unsecured debt at bank holding company levels is potentially fraught with additional risks that nobody really had considered previously. It says that banks are going to have to really stand on their own at the holding company level. Keep in mind, the capital of banks are really in their subsidiaries. That's the required capital.
Yeah, the structure is a holding company.
Right.
The subsidiaries keep the capital,
right,
and for solvency purposes.
And then, of course, you have all the issue of the fact that most banks today are not really depository institutions only. They are actually big trading firms. And so what Dodd-Frank did is it's put considerable constraints around their trading activity. But on top of that, it has, because of these types of changes, is making it, this downgrade is potentially making it slightly more expensive for those trading operations to raise money. In theory, their interest rates should go up. Having said that, this announcement was so expected that, in fact, interest rates didn't rise at all.
If you're Moody's or your S&P 500, you look at these ratings agencies, isn't this a little bit, they're finally now getting around to lowering ratings
I
on the
remember
banks?
I was on television the night the U.S. was downgraded, and I just couldn't help myself. I said, so who are we listening to here? Right. No, as a practical matter, this was just basically a policy change at the rating agency level. Same thing with Standard & Poor's. They had to incorporate the notion that the change in the law was actually going to expose bank creditors. And as a practical matter, bank creditors today are basically quasi-equity at the holding company level. If, in fact, there's another crisis, they will obviously wipe out the equity
holders.
But they will step into the position of equity
Finally, is there
holders.
any impact on consumers then?
None whatsoever. Absolutely none.
Okay. Dan Alpert, thank you so much.
Good to be here. Thanks.
I'll talk to you again soon. When we return on Arise Exchange, an infomercial king is ordered to jail and our favorite person of the day. Stay with us. Dan, that was terrific. Thank you.
Good.
Time now for our favorite person of the day, when we pick one person who grabbed our attention and not for the right reasons. Today, that person is infomercial king Kevin Trudeau. Trudeau may have fooled millions of late-night television viewers into buying a bunch of useless healthcare and financial products, but he ultimately couldn't fool a Chicago jury who convicted him of ripping people off in commercials for his best-selling weight loss book and then lying about his ability to pay a $37 million fine. His refusal to pay the fine led to criminal contempt charges. Trudeau claims he's broke, but the government says he's hiding the money in offshore accounts. Trudeau hawked his weight loss book, telling viewers that there was an easy way to lose weight, when in fact the book told people they needed to buy a prescription to a hormone only found in pregnant women and could not eat more than 500 calories a day. In half-hour infomercials, he also said he, quote, uncovered a weight loss secret initially discovered by a British doctor in the 1950s, and the government covered this up to protect food companies. Well, Trudeau will now try to sell his weight loss products in jail because that's where he's off to. He will be sentenced in February. So, no infomercial tales here. Kevin Trudeau is our favorite person of the day. Ahead, a small business that has brought the yogurt craze to a new market. You're watching Arise Exchange. Stay with us. After the frozen yogurt business thawed out in the 1990s, the industry saw a boom in the 2000s with chains popping up everywhere. And experts predict it won't slow down anytime soon. According to the Los Angeles Times, according to Los Angeles-based industry research firm Ibis World, by 2017, the entire U.S. frozen yogurt industry, including both franchises and individual stores, is expected to top $931.5 million in revenue annually. Gene Alert decided to get into the boom and also benefit his community, where he says there is a void in stores that offer healthy food choices. He opened the first frozen yogurt shop in Bedford-Stuyvesant, Brooklyn, and he joins us now to tell us all about it in tonight's Small Business Spotlight. He's also the author of Do Right, Do Good. Welcome, Brooklyn Swirl co-founder and author Gene Alert. Gene, thank you for stopping by. Let's just dig right into the yogurt. What do we have here?
Thank you, Andrew, for having me. First off, this is the mango. This is our non-dairy flavor. And we have vanilla.
So why frozen yogurt?
Well, me and my wife wanted to open up a frozen yogurt shop in the area of Bedford-Stuyvesant because we live there, we reside there, and we wanted to fill a void.
And Bed-Stuy, for people who don't know, is in sort of the eastern area of Brooklyn.
Yes.
And so you wanted to get into the yogurt business. Go ahead.
Yes, we wanted to get into the yogurt business because we wanted to fill a void. We wanted to provide something healthy.
You know, it's interesting about the void because for those living in Manhattan, there is a frozen yogurt shop every 2 blocks. It's like Starbucks all of a sudden. But from what I understand, in minority communities, it really hasn't yet taken off. And why is that?
I haven't done enough research to tell you why there isn't enough frozen yogurt shops in minority communities, but what I wanted to do is contribute a healthy alternative in our area and provide something where we could give soups, also smoothies, which is fresh fruit, and give the kids something healthy to snack on or after school.
And what has been the reaction so far? How difficult is it to open up a new type of business in a neighborhood?
You know what? People had to get adjusted to it because they weren't used to frozen yogurt. So we had a lot of resilience at first, but once they came in and sampled the yogurt and saw what we were offering, and then another part too is we wanted to build up the community. So we felt that if we invest in the community was investing in us.
You're another individual we've had on who sort of started in corporate America and has now gone off on his own. What is the difference? There's all these challenges, but it has got to be a great thrill to be on there on your own.
Yes, it has. I started off in banking when I was 18 years old. I started my first business when I was 24, a marketing firm, Alert Card & Associates. And recently, you know, I opened up the frozen yogurt shop and I published my first book.
And we'll talk about the book in a moment. You were born in Haiti.
Yes.
And so how has that sort of affected your worldview of business here, would you say? In a very poor country that has a lot of problems.
You know, my family brought me here when I was 6 years old and moved me to Long Island, Deer Park. And from there, I saw opportunity. So they instilled opportunity in this country, in my mind, to take advantage of the opportunities that this country provided. So I never really used and had any excuse or made anything because I always walked in faith.
And entrepreneurship is about that. The faith, a lot of what you're doing. And your book is subtitled An Easy-to-Use Guidebook Towards Vision, Fulfillment, and Entrepreneurship. And isn't that what entrepreneurship is about? It is having the vision and fulfilling it.
Yes. Yes, I agree.
And how do you get there then on a daily basis because of the challenges? You face regulations, you face banking challenges, obstacles every single day.
Education. You know, and you have to do your due diligence. You have to do your due diligence. You know, there's the public library, there's Barnes & Nobles, there's so many different resources out there to educate yourself.
What's next for Brooklyn Swirl?
I definitely want to open up some franchises. I'm going to sit 2 years and maybe open some more out of state.
We have about 30 seconds left, and I ask all small business owners, how do you feel the business environment is, both in New York City and in the country right now?
You know what? I feel that small business owners are going to be the staple, where that's the growth of America. That's where it
always
is.
has been.
It always has been, yeah, especially in New York.
Okay, Gene, thank you so much.
Thank you.
Gene Alert from Brooklyn Swirl. We'll try that in a few minutes, so stick around.
All right.
Next week, high-tech headphone maker Monster unveiling their latest in ear candy on Monday. CEO Noel Lee will stop by to show us the goods. Now for a quick recap of the markets, take a look here. The Dow record high, closing in on 16,000, closing in at 15,962. I'm Andrew Schmertz. Have a good weekend, everyone. That is Arise Exchange.